Alright, hello, and welcome to Camel Finance. I'm your boy Camel, and not your keys, not your coins, but also not your keys, withdrawals disabled. Okay, we have had Voyager temporarily suspend trade-in deposits and withdrawals and loyalty rewards. Okay, so this is another exchange that looks like it may or may not be about to break. At the same time, KuCoin, people are reporting not being able to get in or out of their KuCoin exchange accounts. So this is not good. It's also, unfortunately, likely not the last one of these you're going to hear about. We have, of course, this is all coming off the back of the lunar collapse, Celsius blowing up. Yet another exchange has halted withdrawals, and scrolling down here will just tell you exactly what I've been saying. So you can go and check that out. Keep in mind, Gemini, the exchange Gemini might also be in trouble. So you can, type that into YouTube and go and check that out if you hold a Gemini account or you're concerned about that. And of course, this is coming off the back of what is possibly going to be a bailout for BlockFi, FTX. Maybe they're going to do it, maybe someone else is going to pick it up, or maybe they go broke. But you can see that the theme is a lot of these over-leveraged players, a lot of these lenders, a lot of these exchanges are really suffering because in a bear market, they hold a lot of crypto. The crypto assets depreciate in the bear market. People stop trading as much. People stop buying as much. They make less from fees and new users and so on and so forth. So in a bear market, these exchanges, they suffer a lot. It's not to mention that what seems to be coming to light is most of them have been far too highly leveraged during all of this. And so if you have any crypto on exchanges, you want to get robbed at this point. So get your crypto off of exchanges, put it in cold storage. There's a link in the description to Ledger's website, so you can use that and go straight there and sort yourself out with a cold wallet. They start from 50 or 60 quid. And even if you're the sort of person that's thinking, well, I only have a couple $100 worth of crypto, I've only got 200, it's not worth spending the 60 quid. Yes, it is, because add a zero onto the end, and that's really what it's going to be valued at in a few years, most likely, right? So if you have any crypto at all over 60 quid's worth, then just spend 60 quid to protect it, because otherwise, you're just asking to be robbed at this point. So anyway, rant over. Link in the description if you want one of those. Facebook, parent company Meta, will shut down its crypto money transfer service. So it looks like perhaps they have decided that there's too many regulatory hurdles to get their little Facebook coin through, or perhaps they just realized they could use Bitcoin instead. People can use Bitcoin instead. Why wouldn't you use Bitcoin? Bitcoin works perfectly fine. And I don't know if anyone's used Lightning. Put it down in the comments if you have, but Lightning has been really impressing me lately. The US Commodity Futures Trading Commission, the CFTC, has just charged Mirror Trading International, MTI, and its operators with a $1.7 billion fraud involving Bitcoin. The commission is charging this man, the proprietor of the business, for operating an illegal multi-level marketing scheme designed to extort Bitcoin from members of the public for participation in a commodity pool administered by MTI. So a lot more people will be suffering from this. You can kind of see the theme of today. Get your crypto off exchanges, stop trusting people, stop chasing 5, 10, 20% yield when, Bitcoin over the long term, over a couple of years, does 3-figure returns. Bit of macro coming up. Weakness in commodities equals lower inflation. The commodity tracking index has recently broken its bullish trend line. So you can see here we had this technical breakdown, long-term trend line. And this is on a bearish MACD cross, moving average convergence divergence. So is this hinting at us that inflation may have peaked? We may have seen peak inflation. Well, Raoul Paul says, to everyone who says the Fed won't cut until inflation peaks, 1974, 89, and 2008 are contrary evidence. Those are 3 of the 4 largest inflation episodes in the last 50 years. He says, I don't expect them to cut yet, but pause soon, then cut. What's interesting is I saw Raoul Paul on Robert Kiyosaki's podcast, Rich Dad, I think it's called the Rich Dad, Poor Dad podcast. And that's on YouTube if you want to check that out. But he was saying that Raoul thinks we might have already seen the last rate hike. Raoul thinks we might have seen the last rate hike in June. He says that they're likely not going to do one in July. Now I don't know how likely that is. If you've been watching the channel, you'll know that I've been sort of thinking we would see the pause around September. Maybe they announce it this month. But I thought that was quite interesting to hear somebody like Raoul, who is a macro expert, come out and say that he thinks the Fed is bluffing as well, and he thinks that we may well have already seen the last rate hike. So that would be really interesting. This chart, of course, showing that the 3 cases of high inflation in which the Fed actually cut before we'd seen peak inflation. Root has presented a new perspective on the Bitcoin cycles, leveraging on-chain and cycle theory, aligned by all-time high and then scaled by realized price. We can differentiate between a blow-off top and a distribution top. So of course, this pink one being the current cycle with this distribution top versus the two prior that had blow-off tops. But you can see if you normalize by realized price, these cycles, and then you take this as, you know, this was the all-time high of this cycle, but if you omit that fact and take this as the actual top based on the distribution and on-chain and of course the realized price, then you can see that enough time has elapsed here to have found lows. And it also shows that any further downside from here, sub 17k and perhaps between 13 and 17k for Bitcoin, would represent, at least based on the prior cycles and realized price, an extreme value zone. So do we get down there? Do we get a bounce first and then get down there? Nobody really knows, but certainly if we do, I have absolutely no problem backing up the truck and adding to my stack down here personally. Mark Minervini, champion stock investor, he says he's starting to hear some analysts say that inflation may be here to stay, which he thinks is ridiculous. Just the type of sentiment he wants to hear. The bearishness is picking up steam. If the market suffers another leg down, our work suggests it will be the last leg before a sharp rally. And again, if you've been watching the channel, you know this kind of aligns with what I've been saying as well. We took a short position, we'll hang on to this. We are expecting either a double bottom or one further low. I don't know, I've put this target down here, but like this is arbitrary really. It's more to do with the time and window, which is denoted by this blue vertical line. We'll cover the technical analysis later. The point I'm trying to make is more and more of these high level analysts are starting to see the same thing. Jerome Powell, the most important risk chair in the world. Okay, he is the chairman of the Federal Reserve, which is the central bank of the United States of America. And of course, America currently in the position that holds the world reserve currency. The dollar, of course, being the world reserve asset. And so, where am I going with this? Well, I don't even need any more words. Just listen to this.
Way to say it would be, I think we now understand better how little we understand about inflation.
That's not very reassuring.
No, honestly, this was unpredicted. I was looking at our at the time of our June meeting 1 year ago, of the 35 people who filed with a survey of professional forecasters, 34 of them had inflation below 4% for last year. And of course, way to say it.
So they're not even trying at this point. They're not even trying to convince anyone that they care anymore. They're just openly telling you they don't care. They say things like, I think we now understand how little we understand about inflation. I mean, don't get it twisted. They're liars. They are barefaced liars. They know exactly what they're doing. They need the inflation. They have no intention of making inflation go away. As I've been saying for weeks now, they had no intention of really raising rates or crashing the market. It's all a fugazi, it's all a show, and this thing is coming to the end. I can see this. There's going to be this pivot coming, as I keep saying. How do you get to the point where you're sat in the most powerful finance chair on the planet and you get to say things like, I think we understand how little we understand? I mean, no one's ever been more wrong than this guy. Remember, inflation was transitory and so on and so forth. So anyway, I'm not going to get into a huge rant about that. Great thread from Rao here. Not so fun macro thoughts. He says, fighting 8% CPI, call that the global average. No idea what it actually is, but that seems about right. So far, we have destroyed 21% of global GDP in equity values, 10% of GDP globally in bonds, 5% in other assets, and soon probably another 2 to 3% of GDP growth. That's a lot of wealth destruction. 36% of global GDP. He says his fear is for the baby boomers. At around 67 years old, they really can't afford to lose this. Yet they couldn't afford the inflation either. If it persisted, which he doesn't believe it will, commodities might remain high due to supply issues, but it's the year-on-year price change that matters the most, and they won't persist to the same extent. Terrible situation, he says. For younger generations, this is just another opportunity to acquire assets at discounts, especially if the housing falls too. There's likely a bit more pain to come too, but that means the Fed will need to eventually come back into play. It's all demographics. And all of that leads to this, which bails out the boomers again. So you can see when the Fed steps in, they print the money, everything, they expand their balance sheet by printing money and adding the assets to their balance sheet. So essentially they print money and they bid the market up. That leads to enormous bull runs, which of course affects the boomers again because they're the ones that already have the wealth built in their pensions, 401ks, so on and so forth. So for the boomers, the choices are: do you get your pension value destroyed, or inflation eroded annual pension payments, or is it QE to infinity? So are they going to just print money to infinity to get rid of their 30 trillion debt? Well, of course they are. This is the most inevitable outcome, in my opinion. All of this is going to lead to more debt for those with low pensions or savings to offset this, which leads to the need to debase debt via quantitative easing. So that's what I was just saying here. And what this does is it screws anyone younger who just get poorer in asset purchasing terms. So essentially, young people are the most screwed here because they haven't had enough time to build wealth. They don't earn much money as it is, so they haven't been on the career ladder long enough to have built up big income. And the whole time, this inflation is just destroying their ability to ever accumulate proper assets. So this means that young people either have to opt out entirely or take more risk, as crypto and tech are the only assets that have outperformed the debasement of fiat, although of course they're riskier and more volatile. So this is the price that the young generation has to take. You know, this is why I try to do my best to educate about Bitcoin as much as possible, because if you don't buy Bitcoin, especially if you're young investors have a massive advantage here in the sense that they've got time on their sides. You know, you can buy this and accumulate this asset and then sit back and watch the volatility unfold. And you don't have to be so worried about losing enormous portions of your wealth in the short term to these volatile swings. Whereas if you're a much older investor, the last thing you want to do is be watching your portfolio that you've worked your entire career for start to swing by 80 or 90%. The regulators, however, are trying to stop them taking risk, which is a guarantee of them getting poorer over time, as the real wage growth is 0.2% on average over the last 50 years. So whilst your wages go up 0.2% on average, inflation is currently running, at least in the UK and the US, at around 20%. Okay, so think about it. The only way out of this, the only one chance you have, is to store wealth in a digitally scarce asset. And the only way out for the Fed is negative real rates for 20 plus years. And that still comes with a price. That allows debts to reduce and assets to rise. But then the boomers will get screwed as the value of fixed income coupons decline in real terms and they get poorer. So what an absolute mess for everyone involved. Okay, boomers work their whole lives for a pension and for a house, only to watch their pension be eroded, only to watch inflation destroy their income. And the young generation is screwed because they can't even afford a house. They're never going to earn decent wages, at least not relative to the way that inflation is going to keep continuing to rise. They don't have the income and the disposable income to accumulate assets. And if they're lucky enough to be able to buy some Bitcoin or some hard assets every week or every month, then the price they're going to have to endure is enormous volatility, which takes balls of steel to hold. It's not easy to hold a 90 volt asset. You really have to do a lot of research. You really have to know what you hold and be confident in what you hold. Got this from Jurian. The markets have flashed some optimistic signals recently, but the high yield spreads are a sign that risk off mode isn't over yet. And so this is kind of in alignment with what I've been saying, what Minovini has been saying back here, and what we expect to see from the charts. So I've got this. I thought I'd share this with you because this is actually a really good perspective. The black dot here, 2022, shows us that we are right in the timing window and the percentage from the all-time highs for a typical bear market, assuming we don't enter a recession. So the average non-recession bear drops 25% over 9 months and 34.5% over 15.3 months if we're in a recessionary environment. So over 50 years, the median non-recession bear market fell 18% over 6.8 months. If the economy can avoid a recession, then the current decline is approaching the average for both time and price, and that's what this shows you here. So just looking at historical bear markets in which we did not have an economic recession, we have done enough in both time and price to start to get closer to this bottom. The dollar looks like it kind of wants to run, but we've been expecting this. We've been waiting for this cycle low to form, haven't we, for Bitcoin? This is Bitcoin's cycle low, so we'll see what happens. Are we going to run or are we going to break down? No way of knowing just yet. The S&P I've sort of already covered in previous videos. We expect perhaps a little bounce and then to roll over, but ultimately we expect either a double bottom or a new low. How low it goes, nobody knows, and then looking to cover this short as the cycle low forms. Oil is kind of hinting that perhaps we've seen peak inflation. We've had this technical breakdown. If you're following the channel, you'll know that I said we need to get rejected here to stand a chance, and we did. So now if we can continue to get rejected here and come back down to this level, it does give the Fed a lot more credibility in trying to tell us that we've seen peak inflation. So definitely want to keep an eye on that. I think this becomes tradable if we break out of this trend line. So if we go here, break out, retest, and go, that will become a long. Gold has indeed run the stops, or is that a double bottom? More or less the same thing. This is actually forming the candidate for a decent bounce here. So we need to wait for confirmation, either in the form of a swing low pattern. I don't know if you know what that is, just in case you don't. Here you go, here's a swing low pattern. So we've kind of had this. So now we need a candle that opens above and closes above, and then we can call that a swing low. Failing that, then we'll be looking for trend line breaks. But ultimately, we can't get super bullish on gold, in my opinion, until we break this trend line. However, it does look like it kind of wants to do that soon. Silver, we got to stop out. We thought we might get the run of the stops, but that's okay. So now we go to here. We will add another long position somewhere up here, I guess. We'll see how this goes. So we're lining this up. Again, not trying to rush in straight away or anything, but I think this is going to go. I think that when this does go, it's going to more than cover all of the little stop outs that we've had. Bitcoin getting ever so close, isn't it? Ever so close to our timing window. We are, you know, just days away now from being able to possibly see a cycle low form. Is it going to form at this low, above this low, below this low? Nobody really knows, but one thing we do know is we should get a pretty decent bounce out of here. And then if we can, particularly if we can break this trend line, we should be able to see some a pretty decent uptrend over the next 2 months. Yields coming off. So this is kind of what we expected. This is kind of hinting that the Fed's going to have to do something soon. It's going to have its hand forced. So we'll be keeping an eye on yields as well. So that's all from me. I hope you enjoyed that. I hope you're doing well in life. If you could drop a like on the video, I'd appreciate it, especially if you made it this far. Subscribe if you're not already. Follow me on Twitter. And it's 4th of July tomorrow, so there might be some weird trading hours. It's not something that affects the UK mostly, but my broker has emailed me to say that some of the market times are changing. So, and obviously I think the US is a bank holiday tomorrow. So I know about 20% of the viewers on this channel are from America. So happy 4th of July for tomorrow. I hope you enjoy doing whatever you do. And for everyone watching the channel, take care. All the best. Cheers.